what we will call relative valuation. It's called relative valuation because we are looking at our competitors and seeing on a relative basis how much should we be worth. Both the discounted cash flow and LBO analysis are what we will call fundamental analysis. In this fundamental analysis, as well as the breakup analysis, what we're trying to figure out is fundamentally what do we believe the value of the firm will be. Leveraged buyout analysis is also somewhat similar. Leveraged buyout analysis takes a look at the core profitability and the core ability of a company to generate cash flow and then say, let's take those cash flows, leverage this company up a great deal, and use the internally generated cash flows to pay down the debt, hence building our equity. We will have a brief discussion on LBOs towards the end of this particular module. For more information on leveraged buyouts, as well as a fuller explanation of the things you must consider when building a leveraged buyout model, please refer to our module titled LBO Overview. In addition, we also have a breakup analysis. In this breakup analysis, what we will do is we will take a look at a conglomerate, for instance, and we will break up each one of their business units into disparate pieces of businesses. For instance, if you were to try to value a firm like GE, how would you do that? There is no one good competitor that actually builds engines for planes, as well as consumers for credit cards, as well as light bulbs and washing machines, etc. So from that perspective, it would be very difficult, if not near impossible, to pinpoint a very good competitor to use for comparisons against GE. So in that particular case, what you might do is you might separate and break apart each one of GE's disparate businesses, value each one of their businesses based on a previous methodology, and then sum them up. Therefore, this breakup analysis is also called sum of the parts valuation. Finally, you would also look at asset valuation. If you have a company who has specific hard tangible assets, for instance, refineries, car manufacturing plants, etc., warehouses, you might be able to take this and say, okay, if there's an actively market traded for these particular types of tangible assets that you can split apart from the business, then let's go and see if we were to build all of that up from scratch, how much would this firm be worth? There's another comment, another bullet that I want you to add at the end of this bullet, 4 words. I want you to write in the words as a big bullet: distressed, restructuring, turnaround, or liquidation. Each one of these 4 are very similar to each other, but they are not on this slide for a specific reason. Because what we are trying to value is the value of the company as a going concern. Steady run rate, they will be around, they are not in any financial trouble, they're not distressed, they're not in a restructuring situation, they're not in a turnaround mode, and they're not in a liquidation method or bankruptcy. So from that perspective, just keep in mind that here, that is entirely separate discussion on how to value distressed and restructured companies. So for now, for this particular module, we will focus on ongoing run rate current valuation of a firm, and we will apply each of these valuation methodologies on top of that firm that we're going to analyze. Moving ahead to the next slide, what we now see is a slide on enterprise value and equity value. Folks, this is an extremely important slide. If you want, just put a big star and say must know. You must know this slide in and out. So where do we begin? First of all, we'll look at equity value. Equity value is simply price per share times the shares outstanding. Other terms commonly are known as market value as well as market capitalization. This one you should have already known what the formula is. And folks, if you didn't know what this is, just pretend you do, because this is a fundamental core concept. Price times shares outstanding gets you the equity value. Market cap, market value, synonymous terms. Now I want to address a particular point, enterprise value. What we actually care about in the valuation of a firm is the enterprise value, not just the equity. What is enterprise value? Well, I always say that finance is not rocket science. We just like to pretend it is to justify our high pay. What I mean by that is, if you look at each term in finance, and if you were to ask yourself, what exactly does this mean? It is very straightforward. Define it using itself. What is enterprise value? Very simply, it's the value of the enterprise. Now, I know what you're thinking. My 7th grade English teacher would come up, smack me behind the backside and say, nope, you can't use your own words to define itself. But when you truly think about it, it actually makes a lot of sense. What is the enterprise? Enterprise is the entire operation, the entire firm, the entire company. So what we were trying to value is the value of this entire operation, the entire enterprise. Now, said more concretely, what we are trying to really capture on our slide is to say that enterprise value actually equals all forms of capital. Enterprise value equals all forms of capital, of which equity value is merely but one component of equity. The definition of enterprise value, sometimes commonly known as levered market cap as well, is simply the equity value plus net debt plus preferred. To this, I will add another term called minority interest. And when we look at minority interest, here's what we want to see. Here's what we mean by this. We want to say form of capital is equity value. That's one source of capital that we receive to fund and to build our business. We also needed debt. We also may have issued preferred, and I'm going to come back to this minority interest in a second. Other terms for enterprise value are also called aggregate value, total capitalization, leverage value, or transaction value, but this is more in a deal context. Now, let's take a look at exactly what this means. Note that this diagram is not drawn to scale, but we have equity value, which usually is the core of where we get our money from. To that, we also add net debt and preferred stock. Usually, when we ask somebody, what is the value of, let's say, Microsoft, people would just say, oh, it's $25 a share or whatever the current stock price is. Or they might actually give you that market cap and multiply by the shares outstanding. But that is not the correct number. That is only one component of capital. A firm will get their sources of capital from multiple sources. Again, equity, preferred, net debt, etc. To which we add minority interest. Let me come back to that in a second. And so when we look at enterprise value, this means that, again, the entire value of the entire firm, the entire operations, the enterprise, whereas equity is merely but one component of capital. Very important here. Now, if all of these forms of capital make up the enterprise value, there's two comments now to make. Why do we include minority interest? What is minority interest? And also, what is how do we want to include and treat capital leases? For that, let's turn to an exhibit here. Let's take a look at what we exactly mean by minority interest. Remember, I gave you a definition of how to define everything. Take itself, switch it around. What is minority interest? Minority interest is simply interest at a minority. Okay, what does that really mean? What that means is, let's say I have a company. Let's say I'm Walmart. Walmart owns, hypothetically, 60% of a Japanese retailer called Seiyu. Because they reach 60%, once you reach 50%, you must consolidate all of your financials of that subsidiary onto your books. In other words, 100% of the income statement, the balance sheet, and the cash flow must be included in this calculation in your financial statements. If 100% must be included, however, we only own 60%. So that means 40% of this on the income statement will go out as a minority interest expense. Think of this as a quote-unquote dividend, or the pro rata share of the minority stakeholders' share in that particular subsidiary. However, for purposes of valuation, we also want to include this number in our quote-unquote net debt numbers. It's another form of capital of enterprise value. Why exactly is that the case? Well, because the U.S. and international GAAP says once you reach 50%, you must consolidate. Well, if that's the case, on the balance sheet, I might have, let's say, hypothetically said, oh, I bought this company for $100. However, that was the total valuation. I only spent $60 because the $60 is what I only own 60%. That must mean that there's $40 on the books that will show up now, also called minority interest investments, or minority interest on the liability section of your balance sheet. In other words, because you were forced to consolidate 100% of the income statement, the assets, the liabilities, as well as the cash flow. Because you were forced to consolidate 100% of that, all of the value must be placed on your balance sheet. If 100% must be placed on the balance sheet, well, I have to take a deduction in order for me to balance, because 40% of that, $40 in this case, is actually owned by somebody else. So now the question becomes, why do we want to include this $40 into our enterprise value calculation? We want to include this enterprise value calculation, this number in there, for the very simple reason that this is another quote-unquote form of capital used to get me that 100%. In other words, this is a form of capital that grossed up my income statement and balance sheet to reflect the full reported numbers. And because of the accounting systems, because this has to be grossed up to 100%, the full reported method, $40 of this liability, you can treat it as if I borrowed, quote unquote, as if I borrowed this $40 to fund the 100% acquisition of this company. Because I used had to get 100% of this onto my books, it's as if I borrowed this $40 to fund 100% of the acquisition. And because I borrowed that $40 to fund this acquisition, that is why we would treat this as if it were debt. Now, that doesn't mean that it is debt. It's not an interest-bearing negotiated security. However, this is in our enterprise value. This is what we were trying to figure out. What is the full capital used to fund my entire business or my entire enterprise? And that is why you want to include minority interest. Now, another point that people always ask is, Aside from minority interest, fine, I understand that this is a form of capital used to fund my business, so include minority interest in my total enterprise value calculation. In other words, if I had to reproduce all of Walmart's financials, all of my target company's financials, how much capital do I need to rebuild this firm? I need to have borrow from my equity guys, from my debt guys, from my preferred, as well as from minority interest to reproduce the exact financials that this firm now has. So then another question becomes, do you want to include capital leases? Capital leases, let's take a look at capital leases. What are capital leases? Well, leases that are capital, that is how we would describe what a capital lease is. Now, what exactly does a lease that's capital mean? Well, folks, think about this. The accounting definition of capitalize simply means what? What does capitalize mean in accounting? This means put on balance sheet. So on the one hand, we have, of course, the flip opposite of capital leases, and that will be an operating lease. And this operating lease, what is an operating lease? It's simply a lease or rent. Let's say I have a $4,000 copier, and I choose to pay, let's say, $1,000 a year for 4 years, so I don't have to own this copier. I will take this copier and I'll rent it for $4,000. On the flip side, if you meet certain accounting rules, you have to capitalize or put this on the balance sheet as if you bought it. As if you bought it. This doesn't mean you bought it. It's still a lease. It's still rental. However, the accountants want you to say, if you meet one of these 4 criteria, which we'll quickly go over, if you bought it, then you have to capitalize in your balance sheet, so your assets via PP&E will actually increase, and your liabilities, capital lease liabilities, will also increase. Let's just say hypothetically by $4,000 each. Now, the accounting behind capital leases and the split of imputed interest and depreciation is actually a little bit more complex. So just note that we are going to simplify this analysis. So the question becomes, why are capital leases not ideal? Generally speaking, this shows a higher asset base. If the asset base is higher, and if you recall from our accounting module, this means that you will show lower efficiency and lower asset management turnover ratios. Lower efficiency and lower asset management turnover ratios. So that is why we generally try to get this off the balance sheet to reduce our capital base. So for instance, return on assets might be a little bit lower. Also, because now you have a liability, a quote-unquote debt that appeared on the books, this will also affect your capital ratios. And this will show that you have more debt. And we, of course, do not like to show the fact that we have more debt. So for these 2 basic reasons, generally speaking, firms do not like to have to capitalize their lease because you have, again, lower efficiency ratios, lower asset management turnover ratios such as return on assets, and of course you now have to show additional debt. Now, if we have said that capital leases are not necessarily ideal, what are the 4 reasons, one of 4 reasons that you would need? If you meet any one of these 4, you have to now capitalize the lease, treat this operating lease as if you bought it, put it on the balance sheet. So here we will say if you are a snob, you will basically have to capitalize this lease. A snob, 75% of your useful life. For instance, if this copier had a useful life of 5 years and I decide to lease it for 4 years, that is, 80%. So therefore, the accountants say, well, you are effectively buying or using the entire life, or 75% of it, and therefore you are not going to be able to get away with just treating this as an operating lease. It's as if you bought it because you're substantially using a huge amount of the useful life. N stands for 90% of fair market value. Folks, if this lease is, if this copier is a $4,000 lease, and in total, let's say I'm paying $3,800, assuming 38 over 4,000 is greater than 90%, they're saying, hey, it's as if you effectively paid for the entire copier. You must now capitalize this, treat it as if you bought it. O stands for ownership. If there's a transfer of ownership, if the transfer of ownership at the end of this, free and clear, at the end of this operating lease, it is yours, then again, they treat it as if you bought it. Finally, if there's a bargain purchase price, for instance, at the end of the lease terms, you can buy it for $100 or $1, it's yours, free and clear. Again, if you meet any one of these 4 criteria, the accountants will say to you, you have to make sure, or you have to capitalize this lease as if you purchased the entire asset. Now, if we have proven that this capital lease and operating lease, the only difference, again, the only difference between this capital and this operating lease is the mere fact of these random, quote-unquote, random 4 accounting rules as dictated by the FASB, the Financial Accounting Statements Board. The FASB had these 4 rules, these snob rules. So what we are saying is from an economic perspective and from a financial analysis perspective, from an economic and financial analysis perspective, the difference between an operating lease and a capital lease is nothing. No difference between a capital and an operating lease. And if there's no difference between an operating and a capital lease, then we are going to effectively treat the capital lease as if it were an operating lease. Now, I know some of you may be thinking, well, we do actually want to include capital leases. We do want to include the effect of capital leases. Or rather, on the operating lease side, we want to say maybe we should add the operating lease back. But again, keep this in mind. When we are looking at enterprise value, going back to the context of this now, when we are looking at enterprise value, what we are ultimately trying to capture is the sources of funds from the financing perspective that I use to gain all of my assets. Whereas an operating lease is still an operating related decision. I need to make photocopies. It's not a financing decision. Now, one could say, well, this capital lease, you needed to fund this copy or something. If you didn't lease it, rent it, you would have had to buy it and you would have had to borrow money potentially to do that. I can't argue with that approach necessarily, but the idea there again is that's an operating related decision for that particular decision on whether or not I needed to run my operations, make photocopies, etc. But what we're trying to capture again is the financing aspect. How did I grow my business initially? Where did I get all the sources of capital I needed to actually grow and build my business? So therefore, we want to look at it from a financing perspective. Whereas this capital lease is still an operating related decision. I need it for my day-to-day operations, as opposed to how do I fund the growth of my business. Slight subtle nuance there. But again, keeping this in context of the enterprise value calculation, that is why we want to make sure that here we want to include minority interest. So on the top here, you can add another box and say minority interest. Because why do we want to include minority interest as a summary? Again, we want to include minority interest because this is another form of capital used to get 100% of our profitability and our balance sheet. Because why? Greater than 50%, we have to consolidate. Likewise, we want to make sure we exclude, or rather do not include, the effect of capital leases, because the difference between a capital and operating lease is purely an accounting definition. And because this is an accounting definition, it does not impact our ability to fund the growth of our business through the financing related activities. So folks, please make sure that you solidly understand this concept of enterprise value, because at the end of the day, whenever we value companies, we always want to value the enterprise value. Then minus the net debt, minority interest, and preferred stock to then get us down to net income, to equity value. Go from enterprise value minus net debt, preferred, and minority interest gets us to equity value. Then from equity value, divide by the appropriate number of shares outstanding, which will then get us our price per share. We rarely want to go the other way up when we're trying to value a standalone company. So this concept of enterprise value, it's the entire firm, the entire enterprise is what I am acquiring, not just the equity component. Moving ahead to capital structure, what we now see is that capital structure is simply what? What does this mean? It's the structure of capital. And again, you may be wondering, well, that's not a very value-added explanation, but what does capital mean? Capital equals money. Why do we care about a firm's capital structure? Because this refers to the sources of funds required to run a business. And again, this will tie back into our concept of enterprise value. And throughout the next half hour, I will constantly wrap back and refer back to enterprise value and put it in the right context before we look at our case study. Common forms of capital include equity, debt, and preferred, as we already talked about. Equity, recall, that symbolizes ownership of a firm or of an entity by the investors. Debt is borrowed money with interest, and preferred stock is actually a combination. Here in this context, I will not necessarily go into a full explanation of preferred stock. There's plenty of language written in any finance textbook there. But another point I want to keep out is, why do we care about capital structure? Simply because capital is not free. Each component of the capital structure, this equity, debt, and preferred, that has an associated cost. So you want to make sure you properly capture that. A quick note on debt. Debt holders, as we know, has a first claim of assets before equity holders. Within debt, there's a different priority of liquidation as well. There are numerous tranches of debt. Securitized loans, for instance, this is usually the most secure. The most secure because there's a specific hard asset like a building, for instance, or accounts receivable that is backing that particular security. So if the company goes bankrupt, that bondholder or that holder of this securitized note will actually be able to get paid back because they have specific collateral that is backing that particular financing source. Revolver is considered a line of credit. It's a revolving line of credit, credit card for the bank, for the company rather. And this is considered to be on the high on the priority list. Why? Because this is extremely short term. This is usually the first thing that the banks will require you to pay back if you are having problems. Therefore, it's the first to get paid. Term loan is also, this is primarily from a bank loan, and they are amortization periods, meaning that you have to prepay or there's a fixed amortization of your principal. Compare and contrast that with a senior and junior debenture, simply meaning a regular unsecured bond or a regular corporate note. And this corporate bond basically says typically we have what we call bullet payments. You pay all your principal back at the end. And because you are paying back your principal at the very end, that is going to be junior compared to the term loan issued by the bank, because the bank would have already gotten back some of their money. Then, of course, you have senior and junior sub-debt, what we call high yield or junk bonds. High yield or junk bonds. And then underneath that, you have your preferred stock, which gets paid after all the debt holders get paid. And then at the very, very bottom, you would have your equity. So this is a very quick summary of the priority of liquidation. Moving ahead to the concept of leverage now. Folks, think about leverage. Leverage is a word that I don't know I can quite define using itself. Leverage obviously is leverage. I mean, how else will you define it? Leverage is the use of debt to fund operations. Here's how I define the word leverage and how I crystallize it in my head. Now, don't laugh when I do this. But basically, think about this. I have a big rock over here, and I have a tiny little rock. And then I have a little board, and I will take this stick, and I will use the small rock and the stick to leverage and move the big rock. How do you like that definition? All right. I know that's not that good, but the concept is the same. We are using something to move something that is bigger. What exactly does that mean? Again, leverage is the use of debt to fund operations. Now, all you have to remember is leverage equals debt. So, what are the advantages of using debt? Well, first of all, debt is usually considered to be cheaper than equity. Why is debt considered to be cheaper than equity? Simply because debt has to be repaid and therefore is less risky than equity. Debt has more known cash flows. You know when and you know how much you expect to get your money back. Whereas with equity, you don't know how much and you don't know when. Another advantage of using leverage is simply that the interest on the debt is tax deductible. In other words, the tax savings on interest payments are not insignificant. They do add up to quite a significant amount. Because debt is cheaper and also because of the tax deductibility aspect, the entire weighted average cost of capital, in other words, the discount rate on this firm, for this firm, will actually be significantly lower than if you did not use debt. And if you recall basic M&M theory, if you remember, basic M&M theory says what? That the ideal capital structure, absent transaction costs and taxes, should be 100% debt. That's not always realistic, of course, because then you look at the modified theory, which then says, okay, it's still a little bit more efficient than using 100% equity. And we'll talk and crystallize in a couple examples when we look at the basic corporate finance of exactly what this means and why debt is good and why it is also bad. For more detailed explanation on our WACC discussion for our discount rate, please feel free to refer to our module, Finance 101, Introduction to Finance. The last, well, there's probably a lot more, but the last major advantage of debt is the simple fact that it reduces your upfront cash injection. In other words, this means that you can actually use less of your own money to start a business to fund a particular project. And again, we'll speak a lot more about that in our corporate finance section coming up in a few slides. Let's now talk about the disadvantages of leverage. First of all, if you have too much debt, this becomes an issue. Why? Because the interest and principal payments and repayments can become a cash burden. If this can become a cash burden, this means that now I have to manage my cash flow and I'm not able to concentrate on actually running the business. Debt holders control the company if bankruptcy is declared. Debtors have liquidation priority, as we spoke about. And debt covenants can be very restrictive. What are debt covenants? Covenants are basically a promise. There are two types of major covenants, affirmative as well as negative covenants. An affirmative covenant simply says you must do this. I must do something. So for instance, I must run the company. I must, I must run the company well. I must maintain profitability. I must go ahead and give you financial reports every now and then, etc. Negative covenants say you cannot do this. I cannot pay myself an excess dividend or excess bonus before I paid off your interest. I cannot go and buy another company without your approval. I cannot go and issue debt senior to you, again, without your approval. So these can become very restrictive at times and hamper the company's flexibility to run their business. The more debt, the riskier the company, the risk of default, of course, increases. And of course, this is where leverage must be managed correctly. And that is where corporate finance comes into play and why CFOs get paid the big bucks. Because at the end of the day, it is their job to make sure that the company has the right optimal mix of debt and equity. And for this now, what I would like to do is let's turn to a sample case study to iterate some of these concepts that we've talked about. The sample case study is as follows. Let's assume we have two firms. They're exactly identical in every possible way. Both firm A and both firm B produce cars and are exactly the same except for the capital structure. Firm A and B both require $1,000 of startup cash for expenses such as rent, legal fees, office supplies, etc. Mr. A decides to put in $1,000 of his own money to start firm A, and this is what we will call an equity injection of $1,000. Firm B now decides to put in $500 of his own money, equity injection of $500, and raised $500 of his debt from his bank at 10%, debt raised of $500. Keeping it consistent with the financial jargon, the capital structure means or is said that firm A's capital structure is 100% equity and firm B is 50-50. So based on this very simple analysis here, let's now take a look at a sample comparative financials. Now, you may not be able to see this on the screen all that well, but you should have a printout of this that you'll be able to refer to and to jot down your own notes. Let's say that we are now in a good economy. Good economy, firm A with no leverage, meaning no debt, has sales of $1,000. COGS of $500, gross profit of $500. Compensation, SG&A, and other expenses total $300, giving me operating income, also known as EBIT, of $200. Now, keep this in mind. I do not have any taxes. Sorry, I do not have any interest. Why do I not have any interest? For the very simple reason that I have no debt. I have no debt on the books here. Therefore, my pre-tax income is going to equal my operating income. Taxes of 40%, $80. My net income is $120. Now, let's take a look at firm B. Recall, firm A and firm B are exactly the same, except for the capital structure. So that means that when we look at our sales of $1,000, they are exactly the same. All the way down to operating income, EBIT, $200. For a fuller explanation of the importance of EBIT and EBITDA, please make sure you refer to our accounting module, Accounting and Financial Statement Integration, in which we talk about the exact difference between EBIT and EBITDA, and more importantly, why they are extremely critical and important. But real quick refresher here, EBIT is simply core, recurring, sustainable profitability to the entire company before the effects of capital structure and leverage. Again, core, recurring, sustainable profitability to the entire company before the effects of capital structure and leverage, meaning that before we include the capital structure and the mix of debt and equity, these two firms should be exactly the same. And why should they be exactly the same? Well, very simply, because up until that point, operating income or EBIT is before the effect of interest, and therefore we have not yet at this point considered the differences. EBITDA, real quick by the way, as we know, is a proxy for cash flow. Again, this is more fully explained in our accounting module. Proxy for cash flow, again, to the entire company before the effects of capital structure and leverage. So when you look at it from this perspective, keep in mind that firm B have $500 of debt, 10% interest rate, $50 of interest expense that they now owe the banks. So when we look at it there, firm A and firm B, up until operating income, are exactly identical in every possible way. They are the same firm, except now when we start getting to our capital structure via interest expense, firm B now actually has interest expense of $50, thereby decreasing their pre-tax income to $150, taxes of $40, net income of $90, and of course that is all summarized right here. Now the question becomes, which firm is more profitable? Firm A or firm B is more profitable? And when you look at it, you can say, well, here's one way to look at it. It is very clear that the absolute basis, firm A made $120 versus firm B's $90. So you can clearly say that on an absolute basis, firm A made more money. However, we want to look at this also on a relative basis. And what we're now saying here is the fact that firm A put in $1,000 of equity and has a return on equity of 12%, the 120 over the 1,000. However, firm B, Mr. B, only put in $500 of equity and therefore has a return on equity of $18. Now, keep this in mind. This does not mean that ROE is the holy grail. This does not mean that ROE is the one and all answer to and the statistic and ratio that you should look at. It is not. Now, the question becomes, why is this going to be good or bad? You can clearly see that firm B has made a lot more money here on a relative basis. They have a return on equity of 18%. And if you were to look at it there and you say, well, I didn't get my $120, but if firm B, Mr. B rather, were to go and start another firm exactly like firm B, and he puts in the same $1,000 of equity, he would now have $180 instead of his $90, thereby giving him the same $1,000 equity injection, $180 of net income of profits. So now, this is in a good economy. Let's take a look at what will happen in a bad economy. In a bad economy, we look at it and say, well, we kind of kept it simple. We said, every one of these numbers in firm A, we just said divide by 3. So that means a 67% decrease in their profitability as well as their expenses. So you will now note that sales is $333, operating income is $67 versus the $200 and the $1,000 on top. And instead of making $120 in net income, we now only made $40 in net income. Keep in mind the interest expense is still 0. So this is a bad economy. We did not do so well on these financials. Now let's take a look at how firm B did. Well, keep in mind, firm B is the exact same as firm A. So that means from sales all the way down to operating income, they have the exact same profitability. What this means is, now, because the banks will not say to you, oh, don't worry, you lost 2/3 of your profit, just pay us 2/3 of the interest expense you would have owed us. Fat chance. So therefore, interest expense stays constant at the $50. And because that stays at the same $50, what we now have seen is that net income will drop to $10. And when we see that net income has dropped to $10 versus firm A's $40 net income, you can clearly see the dramatic difference. The ROE of firm A in a bad economy is 4%, $40 divided by $1,000 of equity. Firm B, however, has dropped down to 2%. Now that it's dropped down to 2%, you can clearly see in a good economy, firm B did better. In a bad economy, firm B did worse. Now, it gets a little bit more dramatic here. Why does this get more dramatic? What have we assumed about these financials? These expenses we have assumed are what type of expenses? We've assumed that they are all variable costs. Again, we have assumed that they are all variable costs, except for this interest fixed cost, and hence you have to decline. In reality, especially if you're a car manufacturing firm and your sales immediately drop that much, you probably don't have enough time to cut your expenses that quickly. So in reality, probably your expenses will be the same, if not even higher, because now you have to lay off and restructure, and you have other shutdown costs. So when you look at it there, these numbers will actually be grossly negative upon the net income. They will both be hugely negative. But who has maintained flexibility at the end of the day? It is pretty clear that firm A has a lot more flexibility. Firm A can now say, well, they can go back to the banks and say, hey, this is a temporary thing. Let me go and figure out, this is my business plan of how I intend to get back to profitability. So let me go ahead and give me some money and I'll prove it to you. Firm B, on the other hand, is going to have severely limited flexibility. They won't have the ability to do that. They won't be able to go to the bank and say, hey, give me one more shot. They're like, no, you barely made it out this year and you still owe us a whole ton of money. So when you look at it there, the key to remember here is also the volatility of the earnings. Taking a look at our numbers again. Whose figures are more volatile? Firm B has gone from 18% to a 2%, whereas Firm A went from 12% to 4%. Pretty clearly, Firm B is a lot more volatile in their earnings. Because they're a lot more volatile, they're also going to have a lot more risk and uncertainty. Because why? Their profitability is a lot more dispersed and a lot more widespread, whereas Firm A is a lot closer together. So here, this again is where it is up to the CFO of the company to properly manage the right optimal mix of debt and equity. What this means is, in a good economy, you want to make sure you're able to maximize your earnings, and in a bad economy, or when the crap hits the fan and you aren't making as much money, you want to make sure now you minimize your downside. And this optimal mix of debt and equity, that is always a tricky thing, but that is how the capital structure now all comes into play and also affects the entire valuation of the firm on the enterprise value. Let's now take a look at valuation multiples. A multiple is simply a ratio. One of the most commonly quoted and cited ratios is simply your price to earnings multiple. Price to earnings multiple is simply a multiple of earnings. However, there are also numerous other multiples such as sales, EBITDA, and EBIT. And this is one of the key concepts here, especially when we look at relative valuation. What this means is the price to equity simply says if a stock's PE is 20, that means you are basically paying $20 to get a dollar of earnings. Said another way, it would take you 20 years to get your money back, forgetting about discounting. 20 years to get your money back. Now, in general, as we know, the higher the multiple, the more the investor is willing to pay for the stock of the company. Why is this the case? For that dollar of earnings that that younger firm, that younger higher growth company made what we're saying is they have the potential to make a lot more in the future. And that is why we are usually willing to pay more for their dollar. However, a lower multiple can be attributed to a slow growth, mature, or even negative, stable company. Why? Because for that extra dollar, for that dollar of earnings, it's going to be that much harder to earn a good return on that in the future. It will not appreciate as much or has less potential. And therefore, this is one way to gauge market sentiment as to see which firm is being placed at a premium. Real quick note on this. Multiples are either forward-looking or backward-looking. Backward-looking multiples, or what we call trailing multiples, use earnings that have been realized in the past. In other words, for instance, the last full year of earnings or the last 12 months LTM. What this means is, if a stock price is currently at $20 and last year's earnings per share EPS was $1, the PE ratio is simply 20 times. However, using forward multiples, because we never want to pay for previous earnings, we always want to pay for future earnings. If the stock price is $20 and it's estimated to have earnings per share of $2, this means that I have a PE now of 10 times. So it's very important to make sure that when you're looking at PE ratios or any multiples that you're always comparing apples and apples. You want to make sure you compare apples and apples. Now, let me go into a quick sidebar and discuss why I believe PE ratios are suboptimal as a valuation metric. Go back to our previous discussion on corporate finance, and when we looked at the optimal mix of debt and equity and said, well, you know what? Think about this. Net income divided by shares outstanding, as we know, gets us our earnings per share. How much net income, how much income do we make on a per share basis? Well, if you look at it from that aspect, don't forget, net income has already been reduced by taxes as well as our interest expense. In other words, net income has already taken out the effect of our financing and our funding. And if you were to quickly look at our previous numbers here, so let's look at our previous set of numbers, and we look at this and we say, if we were to compare using purely PE ratios, in other words, using our net income, $120 of net income versus $90 of net income for firm A and firm B respectively, one might say without any additional information that firm A has a high net income and is a little bit bigger. But we know at the end of the day, in reality, operating income of $200 each are exactly the same. Again, firm A is the same as firm B. However, because we are using this on an after interest, on a levered basis, we are looking at net income, which is our earnings per share. We're looking at this after the effect of interest expense, which that simply means that we have not actually fully encountered and fully looked at the core ability of the company to generate profits. Think about that once again. I believe that PE ratios are suboptimal because it has removed the effects of financing already, and I'm not able to truly ascertain based on just that PE or that EPS number exactly, or that net income number, exactly who is a larger company. As it turns out, firm A and firm B, as we already demonstrated, are exactly the same size. However, you cannot tell that by looking purely at the net income or earnings per share. And therefore, using the PE ratio as a form of valuation metric or the sole source is very, very unideal. Now, there's an emphasis placed in the market today that PE ratios are everything. PE ratios, PE ratios. So just keep that in mind. There are other ratios that we want to also utilize. As we have already said before, you want to also look at EBITDA and EBIT multiples because this reflects your proxy for cash flow, core ability for the company to generate cash flow, and your core profitability of the entire company. Now, in the next few slides, I will reiterate this concept and wrap it back to enterprise value. And more importantly is, why do we care about all of this? Because enterprise value is extremely important. So let's take a look. In this example here, using the same numbers from the previous case study, we have already talked about the fact that we need to make sure that when we're looking at multiples, our forward-looking and backward-looking multiples must be aligned correctly. Let's now take a look at the numerator. This is where the distinction between equity value and enterprise value becomes extremely apparent. In the following example, as we have already stated, firm A has no debt, and therefore enterprise value is equal to equity value. However, using equity value to calculate a revenue or EBITDA multiple for firm B will result in a grossly incorrect multiple. Let's take a look. Firm A, who has no leverage, their equity value is $1,000. They have no debt, so their enterprise value is also $1,000. If I were to take this equity value of $1,000 and divide it by my revenue, EBITDA, and net income statistics here, this will yield me the following ratios. In other words, 1,000 of equity over 1,000 of revenue gets me 1 times. 1,000 of equity over 300 EBITDA, we basically assume that the DNA was $100 because if you recall, EBIT was $200 from the previous set of numbers, and therefore the actual EBITDA is going to be $300. So now I would take $1,000 of that equity divided by the 120 of net income, and that gets me 8.3 times. This got me 3.33 times. Now, if I were to take the same $1,000, but now from the enterprise value, divided by each of these three statistics here, I will get the following multiples, and of course, they are exactly the same. Think about that, folks. Why are they exactly the same? Well, they're exactly the same for the mere reason that equity value and enterprise value are exactly $1,000 each. So therefore, no matter what you do with your numerator, it's the same absolute value divided by the same denominators, revenue, EBITDA, and net income, you will get the same multiple. But now what I want to do is let's take a look at firm B. Firm B, as you recall, has $500 of equity. They have $500 of debt, meaning they have enterprise value of $1,000. Revenue and EBITDA are exactly the same at $1,000 and $300. Why are they exactly the same? Don't forget, this is before the effects of interest and taxes, so of course we have not yet taken away the debt that we have on the books of the $500 or the interest expense, and therefore they're exactly the same. And as you recall, net income of $120 for firm A was comparable to firm B's $90. Now, the question becomes, when we go ahead and say, what is the equity value divided by $500 of equity of firm B divided by these three statistics, what ratios do I get? I get the following numbers. I get $500 divided by 1,390 gets me these numbers. 500, for instance, divided by 1,000 of revenue, that gets me a 0.5 multiple. 500 of equity divided by $300 of EBITDA gets me 1.67, so on and so forth. Now, when I do the same thing, however, and I take a look at the enterprise value of $1,000 divided by the same numbers, these are the multiples that I now get. So again, the difference between firm A and firm B was the fact that we had debt for firm B. So now, what I'm saying to you is, if I simply took the equity value of $500 of firm B, divided by each of my statistics from firm B, I will get a set of ratios that is going to be incorrect. That is different from firm A. Firm A, it didn't matter which one you took because equity was equal to enterprise. Now, note on our slide we have done the following. We have indicated which one of these multiples were wrong and which one of these multiples were correct. So this can be summarized as the following. What we are trying to say is that the enterprise value divided by revenue and EBITDA is the correct ratio. In other words, enterprise value and EBITDA, these are the correct ratios to use. Likewise, for equity value, or conversely, for equity value, the only correct is for net income. That is this number down here. And now, the question I will pose to you is, why is it that enterprise value is the correct numerator when you're trying to figure out revenue multiples as well as EBITDA multiples?
All right. And this is where, quote unquote, hopefully I'm coming in loud and clear. This is where I'll jump in to kind of help everybody along the way and what's taking place. Valuation methodology has a lot of moving parts. And a lot of individuals who are stumbling, fumbling, trying to figure out what exactly are they doing when it comes to accounting, they get stuck in these valuation methodologies. Now, leverage buyouts is the proper approach to acquisitions. So when you're looking to purchase that vehicle, you're looking to purchase that home or building, you should use the approach that every other Fortune 500 company that is GAAP compliant uses, which is the leverage buyout methodology. Now, to act as though you have no true experience in accounting and substantiation, I'm going to use these AI tools to give you a cheat sheet. So if you've been taking notes, I told you to bring your AI to class. If you brought your AI to class, then I'm going to refer to you to some reference materials. For example, those of you that are in Diversity Trust Holdings Limited, you're in that Bitrix space. If you're in that space, then what I'm about to show you is in the Bitrix space. I'm going to show you exactly where this document is at. Matter of fact, it's a data set, if you will. I'm going to show you where this data set is. Just bear with me while I bring it up, and then I'll share my screen so we can get to the business at hand. What I expect is for you to have questions. Why? Why? Because that is the only way we can all learn. Yes, but Bezel Bay is not just a, I consider me a jack of all trades, master of none. I'm a perpetual student. When I'm not teaching, I'm in someone else's class. I love to learn. Because the more I learn, the more I earn. And so I'm all about earning more. So I got to learn more to earn more. In this demonstration, it is essential that you understand that the algorithm for commerce that is governed under Securities and Exchange Commission guidelines and generally accepted accounting principle guidelines, they've all been tethered to look at every standardized debt obligation contract or every standard debt application under a certain lens. Now, again, let's see here. I'm going to go to my Bitrix. Don't panic. I'm going to share the screen. Just be patient. I'm going to share my screen. Let me find it first, what I'm looking for. Then that way I can share the screen and reference it. It was a data set that I gave everyone. And I asked certain individuals, matter of fact, everyone who was able to download this particular document, I asked you to read something. And I'm going to bring it up so you know exactly what I was referring to. And why this is important. There we go, right here. This was posted in Bitrix. If you go to your feed, for those of you that are in the Diversity Trust Limited Bitrix workspace, this posting was placed in the feed to all of you guys back on October 6th at approximately 9:39 a.m. Eastern Standard Time. I am going to now share my screen so you can see what I'm referring to. Okay, got the windows. Okay. All right. This is the data set that I was talking about. Posted in the feed on October 6th. It said free data set, enjoy, read section 1A under asymmetric information. Now, what I'm going to do, because that's what we're talking about, let me close that. They're not ready for all of that yet. Let me just open it up. I'm going to show you how to open it up. You see the More tab. Like some of you guys will go ahead and click this, and then you say, Mr. Bay, it wants me to do this other stuff. If you go to the More tab, drop-down window will come. You hit the tab that says Download. This should start downloading to your device. And once this document downloads to your device, then you're able to access it. Now, again, I'm going to cheat a little bit, so I'm going to put this in my other viewer because I got some tools in the other viewer that I want to use. And I can get jiggy with it if I can get it over there. Let's see. All right, there we go. All right, so we're going to open it up in that one. Yeah, it's giving me that. I'm going to go ahead and close this. I'm going to go back into the share so nobody's panicking. Go back into the share so nobody's panicking. Let's start share. That's what I'm going to do. Then I'm going to go back in here and I'm going to open up the share again. But this time I'm just going to make it the entire page so I don't have to get caught in the rapture, if you will. All right, now you're seeing my whole screen. Now, this is the document that I was asking you to start reading, written by Lawrence M. Ball. Section 1.3. And I'm going to scroll to section 1.3. 1.3. 1.3. I'm a little too far ahead. 1.3. Section 1.3. 1.3. Right there. Page 7. Boom. All right, we know it's going to be on 7. All right, so let's like go over here, page 7, chapter 1, 7, okay, chapter 1, 3, So here we go, we're in chapter 2, too far. Chapter 1 is what we're looking for. Chapter 1, that's 2-1. We're looking for 1-3. 1-3 is what we're looking for. 1-3 is right here. This is the section, but let's back up a little further because see, it's going to give us the summary. I want to actually go back to the actual chapter because there's something in this that you need to read. And not only do you need to read it, you need to apply it. I'm not just about you just reading a bunch of information and then like, oh, I read it, now what? No, you're going to use it. Okay. 1-3. Here we go. That's figure 1-3. We are 14. Allocation of savings 1-5. I'm looking for 1-3. Private loans. Oh yeah, they're gonna go into it. It's something I want you to see because you can't unsee it once you see it. 1-3 should be right here. Boom. Now, I asked you to read section 1-3 to the next section because it's going to include some powerful information that if you just simply look at it, it'll speak volumes to you. How you take a bite out of an elephant is one bite at a time. That's what I'm giving you. It says when financial markets work well, like what Han was saying, when the markets look good, when financial markets work well, they channel funds to savers, to investors. Think about it. When everybody is slapping 5 saying happy days are here again, they're channeling funds from savers to investors. Asymmetrically, the algorithm uses asymmetric information to funnel funds from those that put something away for a rainy day to those that are willing to take that money that they're putting away on a rainy day and invest into the next big thing. So when you hear happy days are here again, they're referring to the fact that they have successfully created funnels to funnel money from savers to investors. When they say the market is bad, just associate, well, if it's good, they're pulling money away from savers to investors. When it's bad, investors can't get any more money from savers. Get it? Got it? Good. When financial markets work well, they channel funds from savers to investors, and they help people reduce risk. But financial markets don't always work well, and sometimes they break down, harming savers, investors, and the economy. The problems of financial markets can be complex, but many have the same root cause. What's that cause? Asymmetric information. What is asymmetric information? It is a situation in which one participant in an economic transaction, commerce transaction, has more information than the other participant. Okay, so we're going to say in all commercial transactions, there's going to be, a creditor, a secured party, a creditor, a secured party, not the same, just one of the many hats, secured party, the creditor, and then there's going to be the debtor. Okay? So one party, either the creditor or the debtor, has asymmetric information about the commercial transaction. Let me explain. The creditor has all these insurances and this, that, and the other, and if it don't look right, you're not going to perform. They can always, I'm getting scared. Let me pass it to somebody else. That's why they have insurance, reinsurance. Let me show you asymmetric information with the debtor. The debtor already know because they done burn bridges all around town. But you don't know that. So guess what? They already know the minute they contract for that car, for that house, they got no intentions on performing. I know it sounds weird for Mr. Bay to talk like this. I'm just simply trying to demonstrate the algorithm. So understand, if you don't understand why it's a good thing or why it's a bad thing, you never get into the remedies that are really available. Why do those that are in the SEC, private sector, hedge fund managing, y'all know who just came back to work, right? You know, it's the end of the accounting year. You do know the elite only work 90 days out of the year. Y'all didn't know that, did you? How dare they? Everybody else got to work by the sweat of their brow. You mean the elite only work? They only work 1 quarter out of the year. The other 3 quarters, they're on vacation. They do enough in 90 days. They like the Marines. We do more for 6 a.m. than most people do all day. They like the Army and the Marines all in one. They do it all in these 90 days. In these 90 days, the elite understand that they have literally set this whole ball of wax up. And this is what they're doing now. So asymmetric information is being peddled, sent, orchestrated all around you right now. But most folks are worried about a government shutdown and, Christmas and Easter Bunny and all this other stuff. So they're literally being handed basketball, football, WrestleMania, whatever it is, because asymmetric information is happening all around these events. Yes, they're actually using the events to promote the asymmetric agenda. And you're going to pay for it. So it is a situation in which one participant in the economic transaction has more information than the other. In financial markets, asymmetry generally occurs between the seller of securities who have more information than the buyers. These two types of asymmetric information exist in financial markets. There's adverse selection and moral hazard. Just see who's paying attention. Is there anyone in class who ever heard of the term adverse selection and moral hazard? I want you to put inside the chat. Rather, yeah, Mr. Bay, I heard of that before. No, I've never heard that word before. Never heard those group of words. Adverse selection and moral hazards. Place it in the chat. I just want to see who's alive, who's breathing, who's picking up what I'm putting down. Have you heard of adverse selection and moral hazard? And what I'll do, just for the algorithm itself, is I'll check the channel. Let me just see who's participating. Who has heard of those terms? I want to know. Let's see. Let me check. Let's see. Who has heard of it? Going to the chat. Okay, we got someone who says no. Heard, don't understand completely. No. Okay. All right. And this is key. See, understanding these terms, overstanding these terms, however you want to pronounce it, is essential. There's two types of asymmetric information: adverse selection, moral hazards. Figure 1.1 outlines both concepts, so let's discuss them in turn. So let's kind of look at it, okay? Here's figure 1. In financial markets, the problems, you have information asymmetry, investor behavior, saver behavior, and the outcome. All right, so let's just say for last one, you got this asymmetric information where there's adverse selection. This adverse selection in the information asymmetry is prior to the transaction. Savers lack information about the investor's characteristics. Here's the investor's behavior. Investors with worse projects are most eager to sell securities. Here's the saver's behavior. Savers won't buy securities. The outcome, financial markets can't channel funds from savers to investors. Watch this on the other end. When it deals with moral hazards, the information asymmetry is after a transaction saver do not observe the investor's behavior. What does that do for the investor's behavior? Investors have incentives to misuse savers' funds. And then the savers' behavior is what? Savers won't buy securities, and the outcome, financial markets can't channel funds from savers to investors. What have you noticed in this first figure? Well, the saver's behavior and outcome, no matter whether it's adverse selection or moral hazards, the saver's behavior is the same and the outcome is the same. Let's keep looking. In general, adverse selection means that people and firms that are most eager to make transactions at the least desirable to parties on the other side. Let me say this slowly. In general, adverse selection means that the people or firms that are most eager to make transactions are the least desirable to parties on the other side of the transaction. In security markets, a firm is most eager to issue stocks and bonds if values of the securities are low. That is the case if the firm's prospects are poor, which means that earnings on its stock are likely to be low and default risk on its bonds is high. Adverse selection is a problem for buyers of securities because they have less information than the issuers about the security's value, but because of their relative ignorance, buyers run a risk of overpaying for securities that will probably produce low returns. Now, let's usher in this information and the reason why our revenue has increased by 300%. Because of adverse selection, a compliance officer can come in and put on your cape and save the day. See, this misinformation or the misuse of information, everything in transactions are what? Based on insurance and reinsurance. Let me break down to you exactly what Eris AI is so you'll know how to utilize, what's the word for the day? Adverse selection. And what's the other word for the day? Moral hazards, to prompt the AI to give you a proper response. Let's demonstrate. First off, we're going to have to know what exactly does Eris do again? I mean, we've been talking about it, but Mr. Bay, what does it do? Well, while you guys were sleeping, I decided to do some research, and I went to Eris AI. I said, well, what is Eris AI, in this regard? I actually phrased the question, what is Eris AI and CCG? Eris AI, which stands for the Arbitration Registry Investment Systems Artificial Intelligence, is an innovative platform designed specifically for civil law notaries, parliamentary draftsmen, and compliance officers. It serves as a comprehensive advanced tool for navigating the realms of arbitration and arbitrage. Eris AI offers a full range of features and functionalities, including an intelligence arbitration engine powered by AI, a notional pooling system, M3 conveyance mastery, and advanced notional practices. The intelligent arbitration engine harnesses the power of AI, artificial intelligence, to assist professionals, yes, you're a professional, in navigating complex arbitration processes. When moral hazards rears its ugly head, you're there to save the day. When adverse selection has been used, you're there to save the day. When you're doing these financial needs analysis, you are looking for moral hazards and adverse selections, and you'll get it in 5 seconds when you ask certain questions that you have mastered. When you understand there's 7,000 words that you're going to need to use on a regular basis to understand how they are siphoning money from buyers to sellers, from investors to savers. There is a plan, and it starts with contracting. It's the Western Union analogy. They're not just doing this like, like Nino Brown riding over and beating you over the head. You're volunteering for this stuff. You're contracting for this stuff. How many purchases have you made in the last 2 years where you were given a stack of papers to read, and because you was in a hurry, the baby was crying, all this other stuff was happening, you just signed, you got the stuff that you thought you got, then what had happened was, or you lost your job, or this, that, whatever the case may be. Now it's a bad contract. How can a contract be good and bad at the same time and you not know it? It's not that you didn't know it. Well, let me just say it the right way. Ignorance of that, because you were given ample opportunity to figure it out, is not an excuse. This is where we come in. If we can identify that information was either through adverse selection or moral hazards, it's insurable and reinsurable, because there was insurance when they got into it. They just didn't know it. Now, I hope you're not getting lost. I told you in the earlier pre-recorded session that when we talk about leverage buyouts and leverage cash outs, this is going to separate the men from the boys. And you need this type of information when I turn you loose with this AI to be able to start figuring out how to navigate this automated underwriting software. If you don't get this, I'm not letting you touch the software. I'm going to tell you why. It's easier for us to just simply say, well, whatever you do understand, speak it the best way, write it the best way, let the AI teach you the right format, and then you'll develop your own processes. I don't want nobody, I repeat, let me tap the mic. I don't want nobody trying to perfect my process as your own. Let me tell you why. There is a lot of things that I had to do to come to where I am. And I want you guys to learn from my mistakes. This is not my information. I just simply took what was there, how it was represented, and I simply utilized things that I could talk about versus the things I couldn't talk about. Because when I first jumped out, I was violating the Privacy Act of 1974 left and right, especially when it came to the notarial process, especially when it came to the A4V and all. Man, look, accounting is cut and dry. And when you understand that you can't prove anything, you can disprove everything, it gets easier. It's kind of like whatever you want to have done, you got to demonstrate it first, then you're allowed to do it. That's a different lesson. Just for those of you that are, I'm just going to utilize my instrument and this, that, and the other and not have to put in no sweat equity. Let me be clear. Let me just bust your bubble right now. You're going to have to learn what you didn't learn, because you're waiting for something to happen that's already happened. Until you recognize it happened and you can capture it in accounting before it happens, you're waiting on something that has happened, is happening, and will happen on time every day. If it happens every day at 7 a.m., it's going to keep happening every day at 7 a.m. It's just whether you're going to get up at 6, drink your coffee, get ready, and act on it. It's going to happen, whether you know it or not. Whether you acknowledge it, jot it down, note and minute it doesn't matter. It's going to do what it's designed to do. It has been tethered to an algorithm and it's operating in tandem. So this AI technology is supposed to be a tool for you to create a competent staff of individuals with specific functions. Moreover, Aris AI provides expertise in M3 conveyance mastery, allowing seamless integration and management of M3 conveyances. This integration ensures transparency, efficiency, and handling conveyances. 99% of the problem is folks don't understand how to handle conveyances. I'm telling you, as a civil law notary, a fellow civil law notary, a compliance officer, a parliamentary draftsman, all of that. It is a rarity that you will run into someone in the public who understands how to convey an M3 asset. If you go into our actual underwriting software and you talk to someone who has a financial background in Sweden, France, Finland, Europe, they'll know how to do it because They're on a different algorithm. Get it? They're on a different algorithm. They will know how to utilize it. There's a reason why individuals here in the States don't know how. And I'm only allowed to talk to notaries in training about, y'all ain't figured it out yet. What did I tell you one of your duties as a notary? Like, what am I supposed to be doing during the day, Mr. Bay? If you're a deputy secretary of state, you're like Spider-Man and Superman on the wall. Look for somebody to save. You're looking for commerce. And once you look at it, you're listening. Every news article, everything you read, everything you hear, is this a result of adverse selection or moral hazard? Oh, this is adverse selection. Oh, this is moral hazard. Let's call it what it is to make it easier for your thinking. If the majority of things in commerce is divided into the public and private, then moral hazards and adverse selection can be both public and private. You just got to call it that. And as a notary, when you call it, you got to be able to document what you're calling, because you're not allowed to make unbonded what statements. So I give you an example. If you want to construe a transaction as adverse selection, and someone on the other end has made a statement saying that this transaction is illegal, you can rephrase by saying, when you say it's illegal, you're really referring to the fact that it's non-taxable, correct? That is a proper way a civil law notary interprets what no one else has interpreted, because you're just spazzing out words and not defining what's being done. It can be whatever the hell you want it to be. So I'm not going to play that game. It's no insurance day. I'm going to bring my definitions into it since you didn't take out the time. You got to catch that, because if you do, the world is an oyster. Everything is an opportunity. So it's understanding the power of this AI. And again, it's only as strong as how it's being trained. I'm using these classes, these courses, all the things that we do to train our AI to not monetize everything, just things that bring about balance and integrity to the estate. Let me give you a history behind what is now known as Eris AI, because this is the same algorithm that started from recapture recovery, banking in the box, and now it's being used in Eris AI. Under recapture recovery, I took a small group of students and pointed them to the fact that if you made $1 and you didn't receive 60 cents of that dollar back, then the Treasury owes you. That was a fundamental reference. That means it didn't matter whether it was a tax return done this way, that way, whatever. The algorithm at that moment, back then, was if you can show me you made $1 and you spent that dollar and you didn't in the last 90 days get 60 cents of that dollar back, where you're owed 60 cents off every dollar that you can show me. Now, we ain't going to get into who shot John and I got 3 babies and 2 baby daddies. We ain't getting in all that. That's a different algorithm. I'm telling you, the system is set up right now, to this day, that if you spent the dollar, 60 cents is owed. If you miss that, you're going to miss all this other stuff. If you put emphasis on everything else, that means you're tethered to a different conversation. You're in that debtor conversation. And we can have those conversations, but for you guys that are in training, to avoid the headaches, stay in the safest place. There is no one that's serving time in a state facility or a federal facility that's ever handled a general intangible asset. Everyone that's in prison, jail, got picked up on a humbug is because somehow their commercial energy was tethered to an M1 asset. I don't care if you had it in your pocket, in your purse. You just got paid, got into an argument. This is why the local jokers, if you got more than $500 in the Federal Reserve notes on your person, they can confiscate it, even though you got a check stub and call it drug paraphernalia. and take it, and you'll never see it again. Think about that for a second. If you're walking around with more than $500, they can call it whatever they want. Why? Because they're going to use adverse selection and say you're a moral hazard and take it. I need to kind of talk like that. I think they'll get it if I talk like that. Anyhow, maybe I'm going too fast. I'm getting scared. I'm getting nervous. Let me stop. Let's open up the floor for questions right now, because I may have said too much. Press 9-4 on your keypad if you got any questions, comments, or concerns of anything you heard up until this point. Press 9-4 on your keypad if you got any questions, comments, or concerns over anything you've heard up until this point. It'll let me know that your hand is raised. We got a lot of people in the queue, so please understand that I'm going to have to kind of look through to see whose hand is raised. But if you got a question, comment, or concern, please press 9-4 on your keypad so that I can give you an opportunity to ask your question. Okay, I see we got, what I'm going to do is I'm going to call you out and unmute you. All right, I think we got Miss Wilson who has a question.
Oh,
Miss
man.
Wilson, can you hear me? All right.
Yeah, I wasn't expecting to go first. Okay, so just, I'm going to try to reiterate what I think I heard. So, the two things that we're looking for is the adverse selection and moral hazard within everything that we're doing. And is it the reason you're saying that they owe us 60% back is because we're majority owner in the of this corporation?
Correct. Now, remember, everyone in commerce, whether they want to believe it or not, are being treated like corporate fictions. You are a corporation. Whether you started a business, it doesn't matter. That's how you're looked at in the system.
And we're the majority. They're the minority. That's why they owe us back the 60%.
Right. And so you got to remember, when business is good, they successfully exploit that they take money from savers to investors. Investors want to take your insurance premium and what? Invest it. Use it. You're comfortable in paying your insurance premium because something might happen. Timmy might break his leg. Car might get smashed. You're comfortable. See, it's the same. Here's what it is. Everybody can do what everybody else is doing. It's just when one party has more information than the other, that determines the behavior. Remember, when there's adverse selection, the borrower's behavior is the same. You notice in that chart, once there's moral hazard, once there is adverse selection, the behavior of the debtor, the saver, is the same. This is why the elite spend a tremendous amount of time convincing you that they don't exist. Like, the greatest trick the devil has pulled in this conversation is that they have everyone that's a debtor convinced that gold and silver is worthless.
Right. So I have a follow-up question to that.
Sure.
So the M3 conveyance system, does that work? So everything around us, they're creating these assets. So does that work trust to trust, or I know like the trustee has to, we're the notaries, and how are we getting the information into that M3? Is that the research that we're doing and then load?
It's the research that equivalates to the accounting. All things in commerce, how you execute your Article 9 security interest is through accounting.
Okay.
It's the action. Like, accounting isn't just me just recording numbers and that's it. It's an action. It's an action word. Accounting. You're holding other institutions accountable because you have provided the accounting. You have the valuation methodology. What Han was just breaking down to you guys in the valuation methodology video
Mhm.
When it
Right.
comes to leverage buyouts,
We want the
accounting,
enterprise.
right? Accounting goes into action once you understand the moral hazards and adverse selections that are being used. See, a lot of individuals, when they come to a deal, it's greatly undervalued because they don't understand adverse selection. Remember, it's asymmetric information. Somebody has information everybody else don't know. So as a civil law notary, as a compliance officer, as a parliamentary draftsman, we talk about absolutes and fundamental rules. Like there's the rule that I want you to associate. Like if we were having a debtors conversation, I would tell you to master the rule of 72. Now that you're a compliance officer, I'm going to tell you about the 1% rule. It only takes 1% of anything to do 99% of it. You do the accounting and show the 1%, and everybody else will create the 99.
Oh, got it. Okay. Okay.
So if you're a debtor, it's understanding the rule of 72. As a compliance officer, if you understand the rule of 72 as a debtor, you should be able to conceive the 1% rule. Any other questions?
Not at this moment. I'll let somebody else ask a question.
All right. And I'm just gonna call them by your last name. Miss Ashbury, I think I got you. Let me know. Can you hear me?
Hello?
Yes.
My question is, I have some silver, and like you said earlier, they say it's worthless. Can you explain to me how it can be used?
Okay. Understand that silver and gold, precious metals, have an intrinsic value. It also has an allodial value. In the valuation methodology, they talk about intrinsic value and enterprise value. But even in enterprise valuation, they're talking about intrinsic. So silver by itself has an intrinsic value. It is used in a multitude of different resources, from computer products to defense. So let's just talk about the United States government under the democracy. Even though when you say, I pledge allegiance to the flag of the United States of America and to the republic, I don't remember taking an allegiance to the democracy. But anywho, supposedly under this democracy, it's under military rule. So please understand that our government, tethered to the military, is not at liberty to tell you that if you have gold and silver, then you can do X, Y, and Z. They want to reserve that power. So there's an agenda. If you are a United States citizen, you're going to be told what we want to tell you. You're going to be taught what we want to tell you. And when it comes to your gold and silver, this is why we're going to go in your hood and put up, we buy your cash, we buy your gold for cash. Think about this. The cash that you use to get the gold, the cash is lost 90% of its value power. And the gold you got rid of kept its intrinsic value. Simply look at the price of gold and silver and compare it to the price of the dollar. What is lost value? If it's lost value, it's not intrinsic. So because we don't read that detail, this is how they're doing the banana in the tailpipe in front of us. Now, how do you recapture that? Once you know that, incorporate that back into your confidence game, because every citizen has an ability. When you lose confidence in the dollar, you can put your confidence in something else, and it can be the 5,000 euro standard, which is gold and silver. Once your confidence is tethered back to that, then you can demonstrate commercial paper. You can utilize the fact that, and this is a wonderful thing about precious metals, you don't have to barter it to get a value. You can hold it in your purse and write negotiable instruments like everybody else around the world is doing. This is why the elite, they use money that you call money, fiat, when it's in the nominations of $1 million bills, $100,000 bills, and so forth, because that's institutional money. And that money is actually still backed by precious metals. So let's say it again. How can they tell you and I that precious metals don't have a value when the rest of the world has damn near gone back to a precious metal standard? So once you know that, you incorporate that into your trust res, and then you allow this AI technology to tell everybody else what they need to put on their books to use that value on their books. It's about having your own system, not trying to take your gold and silver and put it into their system. Because remember, what are their systems designed to do? When we talked about moral hazards and we talked about adverse selection, it's designed to what? Extrapolate and exploit. See, they call the market great when you as a saver are saving. Listen to this. The person who is telling you that gold and silver don't have no value, I bet if you went in their closet, they got plenty of it.
Probably so.
They have plenty of it. So you got to understand, if I tell you it ain't worthless, it's worthless, you'll wait. Well, you'll hand it over, right? You'll give it away. You'll devalue it. You'll want something that has less value. So with this AI technology, it's just easier to see it. And you can develop your own platform. Eris AI is designed to give you guys that edge. So I love that question. Love that question. Any other questions? You have any other questions, Mr. Ashbury?
I spoke with a realtor today, and he was asking me if I wanted to get a broker. And I was like, why would I need a broker before I even make my decision on, the house that I'm going to purchase? I said that would be just a waste of time. Let me decide what I'm going to do first, and then maybe I consider that.
Right.
What exactly do that broker do? He's just like a person in the middle.
He's a middle person.
Paying.
Right. Like when you're dealing with real estate, and we'll call it a real estate broker for conversation so the algorithm can pick it up. The real estate broker, they're in the middle of the transaction, and they're there to either, if the seller hires a realtor, their job is to protect the seller. If it's a buyer's realtor, they're there to protect the buyer. They're the middle persons. Now, here's where asymmetric information comes in that. Truth be told, 99% of the transactions get stuck in the pipeline because of that broker. And it's not their fault, but it's set up that way. A broker makes about 7, maybe 10% of the value of the purchase price of the property that is sold. Maybe their contract's a little bit more, a little bit less, just depends. In my opinion, if they are in the business of selling property, you want to get your hands on that what? Asymmetric information about the property and the seller. When you do a leverage buyout on real estate, you want to know whether this real estate is still in a what? A loan. Why? Because I can fill out paperwork and assume the loan. Everybody in real estate know that, but again, that is going to put somebody out of a job. They're going to feel a certain type way, so we'll handle that for you. And it has become a profession where we don't like to read, so we'll hire a realtor who's supposed to know all this stuff. And I deal with a lot of realtors who don't know their stuff. I mean, they make a commission, but you ask them about, hard-nosed information like, DCF models, is the loan assumable, this, that, and the other. They kind of look at you with their eyes crossed, and they want to tell me about, their program and their lender. Like, first off, right, I don't want to talk down on realtors, but I want to say, at the end of the day, I'm a fiduciary of an estate, and I'm going to be using the M3 conveyance to acquire this real estate. Now, we can cut straight through the chase. Have you ever done an M3 conveyance? If it's no, then I need you out of the way, not in the way. I'm going to give you a set of rules. You go find these properties according to these rules, and we can close these things all day. Because, see, if I hand you the rules, you ain't going to get stuck in this debtor mode of he's just going to do this one purchase and go away. If I hand you my rules, I have to buy real estate on a continual basis. This is just one of many parcels because it's an estate. But see, to get to that, I'm not here to blow anybody's mind. I'm trying to open your mind. And when you're dealing with these brokers, that line alone usually blows a lot of the brokers out of the water. So you have to strategically know this and, pretend like you don't. When you find something that you like, you allow the algorithm to bring forth this information so you can make a strategic decision. But you're ultimately when real estate don't close, in my opinion, there's no such thing as a deal that can't be done. It's rather it's worth the time and energy of doing. Because a lot of people will get on their soapbox about my preacher, my pastor, my lender, my realtor, and they ain't got nothing to do with the price potatoes in Idaho. So a broker wanting to work for you, wanting to help you, that's great. Give them a set of parameters. Give them some homework. Like hand them an operating circular 10 and say, look, I want to buy the real estate using Regulation J and Regulation Z under operating circular 10.
Okay. Thank you.
All right. Beautiful, beautiful, beautiful. Love the questions. Love the questions. All right, moving down the line. Let's see. I got Brother Lou. If you can hear me, talk to me.
Hey, how's it going? This is Lou.
All right.
All right, I'm enjoying this class as always. Couple things just to clarify. The first young lady spoke about it already, but my question was, as far as examples, can you give like a few examples of how to use an M3 asset? Would you just let it run through credit and loans? And then you said everything is accounting. So as we're learning accounting, that's just regardless of how we do it, we just have to show it in our ledgers is more or less what you're saying, and make it accountable. Everything that we do, as long as it's accountable, we can, that's more or less how we move forward with that.
Okay. Everybody in this class is a notary or notary in training in my book. And when you're not talking to me, when you're out surfing the web, you're a deputy secretary of state. Now, this is how I'm holding everybody. Like, I don't know how you look at yourself in the mirror, but since you enrolled in this class, everyone is a deputy secretary of state, a compliance officer, a parliamentary draftsman, and you're a civil law notary on the bottom. So there's a lot of things that you can do under those appellations. So the handling of an M3 conveyance is never from a debtor's perspective. Matter of fact, it is toxic to think I'm going to do my bill of exchange and I'm going to hand it to Bob. Because who the hell is Bob? And I'm saying that like that's how you got to look at it. Who the hell is Bob? Is Bob bonded and insured to handle this M3 conveyance? If the answer is no, but that's wrong. Bob is a liability to everything that we are doing. So in order for you to hand it to Bob, Bob's got to be what? Ushered in. He's got to be under some sort of oath of office. Bob's got to be given the secret handshake to get to the honeycomb hideout. Why? Because the private sector isn't going around with all these adverse selection and moral hazards they got going on. They don't have to, and you don't either. Once you determine that the individual who is in the situation, the commercial situation, who wants to receive, are they a competent fiduciary? And if they are competent, are they compliant? They have to be competent and compliant. If they fail that litmus test, if they fail that compliance test, then I have no choice but to create the environment and now tell everybody what shirt to wear on Thursday. I got to tell everybody what the rules are. And if I'm going to do that, I might as well determine the outcome and make everybody whole. Because everything out there, because they live in a world of what? Form. There's a tax form for everything. Here's your tax form. Fill it out this way so you can do X, Y, and Z. Well, Mr. Bay, I want fiat. Well, I'll give you all the fiat you want. Let me ask you a couple of questions. Can you produce the last 90 days CTRs for the account that's in question? Well, I didn't know. Well, that's the wrong answer. So if you can't do that, then I cannot commit 15 felonies that I can go to prison for when it comes to handling securities without a license. I mean, you're okay with doing that? Because, see, technically, when you come before me and that's what you're doing and you done admitted it, I'm supposed to report you too. I don't want to do that. I want to do this the right way. I'm saying
so
it
that's
that
where
way.
the tax forms come in.
Right. Everything is a tax.
Got you.
When
Right.
they say we want to do this, you want to hand them a tax form. And when they can't use the tax form, that lets you know when to get on and when to get off at. There's a lot of transactions that I don't participate in because my first fiduciary duty is to avoid public controversy. Taking an M3 asset in the bill of exchange to the dealership and not have done your due diligence is a public it is a public how you want to call it. You're gonna mess around and get a public charge.
Right.
With these people. It ain't that you wrong, it's just they don't want to be right either. Adverse selection, moral hazard. All the cars that are on a dealership are in trust. They're unclaimed property. All you're supposed to do is have your trust contract with the if like, for example, I'm gonna use my own self in this example. I've been partial to a certain type of what we call automobiles. Audis have really been catching my eyes lately. So if I'm in the market to acquire an Audi for the trust, then I'm gonna call the corporate office of Audi, and I'm establish my bill of exchange that way. Now I'm just going to the local dealership and picking out the color I want. But that's just how I do it. You don't have to do that. I don't have to worry about no buffoonery if I do it that way. So the proper way to handle an M3 conveyance is always hand it to a competent fiduciary. And if there isn't one, that's what the courts are for. Your entire process should go from your hand to another notary. The end. If you hand it to somebody that's not a notary, that doesn't have this information, then you're creating a liability. The overcome is that you provide that notary with the proper tax forms and the instructions so they can be the change that everybody wants to see and participate in. See, it ain't your job to turn that M3 asset to an M2 and an M1. It's their job. They got tax forms to do all that. They got insurances to do that. You get to use that value in two different places at the same time. So an example would be that if I was doing a real estate transaction and that real estate was involved in an already existing mortgage, I would utilize a wrap mortgage, meaning that I would get that seller to agree to sell that property to me as a beneficiary of the trust that we're going to create for this acquisition. They will hold a trust certificate unit from the trust as an act of good faith. We're not exchanging fiat. We're giving a trust certificate unit as the instrument that we're holding until the property closes. When we go to the closing table, it's going to be me and my fiduciaries. It's going to be you and your fiduciaries. And what you're going to do is you're going to now present that trust certificate unit to my treasurer, who's going to take it and what? Endorse it. First, they're going to say, okay, this is a specimen. Everything looks great. Go ahead and endorse it. The seller of the property is going to what? Endorse the TCU and then turning it back into the treasury of the trust. Now, after that takes place, all of us are going to stand up and we're going to move one chair to the left. And guess what the seller going to do? The seller going to come on my side of the table because guess what? I just opened up a chair on my board and now he's a trustee. And I'm going to let him fill out the other side of the paperwork. And then everybody's going to be happy. We're going to get the keys to the property. He's going to have all the fiat he can stand. And we're going to do about 10 more of them. That's what Bazell would do. But that's just me. You asked for an example. Any other questions?
No, I was going into the real estate thing next. And so with the realtor and utilizing a realtor, what you're saying is more or less train a realtor to work specifically under your protocol.
Right.
That's what you were
exactly.
explaining
And so
earlier.
you develop
Okay.
your protocols and all of that stuff inside of your AI technology and tether them to your underwriting software. The realtors tickle pink. You know, you gotta give everybody out there is all about form. It ain't hard to do it. It's just it's it requires a little more brain power versus brawn. If you actually ask the realtor for his or her email information and you invited them like Bitrix into your underwriting software, you will have an army of realtors going doing your bidding. Because the AIs don't tell them what to do, what not to do. They're used to that. You're trying to tell them that that's where it gets personal. And I didn't like the color suit you wear, and your shoes were run over. You know, you don't get into stuff like that.
All righty.
All right, loving the questions, loving the questions.
Thank you.
All right, all right. Let's see. Who else do we have with a hand raised? Okay, we got those. I think I got one more person that has their hand raised. Let's see. Here. I see freedom. If you can hear me, talk to me.
Hi. Quick question on that wrap telemortgage.
Mm-hmm.
You hand them the TCU, the Trust Certificate Unit, and tell them to hold on to that. Would they hold it, how many days? Would it be the 90 days until it turns?
Whatever it is that we're getting ready to close. Like you remember in their algorithm, it's about earnest money and all that. Yeah.
Okay. Okay. I also have examples of questions about, I guess, the moral hazard.
Yes.
Versus adverse selection.
If you take moral hazards and adverse selection and go into your AI and give it an industry, ask it to list the top 10 moral hazards in the real estate industry, the top 10 adverse selection principles in real estate, you'll get a very good itinerary of what's there, and then apply that to your algorithm for implementation. In other words, I am very specific in moral hazards and moral hazards and adverse selections because accounting is the culprit. It's the pressure release valve. It's the remedy. It's the magic pill that makes everything work. Do the accounting. The reason why the accounting wasn't done is someone realized or didn't realize it needed to be done. So the remedy is, if you did this with accounting, then we need to look at the accounting to add a chart of account to it to do it. Or you're going to tell me what had happened and this, that, and the third, and I'm going to listen and listen and listen and be like, interesting. Well, who are you in the transaction? Where's the insurance and reinsurance? Where's the accounting? So moral hazards and adverse selections are tethered to the behavior of the debtor. And if the behavior of the debtor is that, oh my God, what am I going to do? There are probably they have been victimized by adverse selection and moral hazards, which are both insurable risks. So your remedy is do the accounting, identify the moral hazards and adverse selections, and allow the insurance to be reinsured. The transaction will fund itself.
Gratitude.
Beautiful. Thank you, thank you, thank you. All right. I'm loving the questions. I'm loving the questions. So with that being said, I want to now go into.
Can I ask one more question before you go into that?
Sure.
Okay. So are we creating our own? So I understand it's like a handshake between two trusts, basically, because then that's why you got to identify what's your position in that particular in that situation. So how are we creating our processes and procedures? Are these some that already exist, or do we have to come up with our own based on each each specific case, or are there like a common Okay.
If you go into any of the AI tools, ChatGPT to be an example, there's plenty of other AIs to use. You want to get a list of operating circulars, and these operating circulars are going to tell you every which way but loose on how value goes from one institution to the other. So once you have a list of those, you now dissect those applicable circulars to know the procedure. And then once you know the procedure or have a list of the procedure or an outline or summary of the procedure, incorporate that into your structure.
Okay, got it. Okay, and then come. Okay, I got you. All right.
All right.
Thank you.
You're welcome. You're welcome. All right. All right. Loving the questions. So without further ado, let's look at some things in the aspect of ARIS and CCG, because the answer that I want you to realize, how do you do it, is you use ARIS AI and CCG. But you got to know what these things are. So I'm going to share my screen once again. Let's see here if I can get back to it. See how that worked? I was just there. Now I'm not. Let's go back. Okay. Sharing screen. Here we go. Sharing screen. Continue. Entire screen. Here we go. Screen's being shared. Now you see the whole screen. All right. To fully be able to engage with ARIS AI, you got to understand how they work in tandem. So let's talk about the vital parts of ARIS. ARIS is actually broken up into 7 parts that we're going to discuss. Part number one is it's an intelligent arbitration engine. Number 2 is a notional pooling system. Number 3 is an M3 conveyance mastery engine. Number 4 is it deals with advanced notary practices, which are parts of the algorithm. It also it heavily critiques, researches, and manifests its expertise and security. ARIS is built on the fundamentals of syntax trust mastery classes, ensuring a deep understanding of the needs of legal professionals. This expertise provides a solid framework for the platform's functionality, ensuring that it meets a unique requirement of civil law notaries, parliamentary draftsmen, and compliance officers. Additionally, ARIS prioritizes security, implementing advanced protection mechanisms to safeguard transactions, records, and data. Just noting and mentioning that I'm wanting you guys to do. Once you have your own ledgers and you kind of got your own system going, now you're just agreeing to meet in a certain space. Notary to notary, house to house, AI to AI. That is going to keep your security and expertise at its highest level. Now, because you're dealing with a panel of notaries that are in good standing in their respective territories, only the author of those documents can testify to its what? Validity and authenticity. So understanding that your commercial registry can be entered into any other commercial registry on the planet is powerful, and we exploit that. We also deal with compliance and regulation. That's number 6. Now, compliance and regulation, ARIS recognizes the significance of compliance and regulation. This is why I was telling you about the up-to-date open operating circulars. They tell civilians are not allowed to utilize notional pooling because this is reserved for those that are accredited investors. So if you are an accredited investor, you are allowed to utilize notional pooling. And one of the documents that you need to have to show that you're an accredited investor is a Form 211. So if you have a Form 211 on file or someone on part of your staff has it, you can actually participate as a what? A market maker. And as a market maker, the notes and minutes that are in those compliance officers' journals are golden. Last but not least, we talk about professional growth. ARIS goes beyond providing a platform for arbitration and arbitrage. It offers legal professions provides a transformative journey of professional growth. In other words, you're starting at the civil law notary level, and you're learning as a civil law notary how to utilize your ability as a deputy secretary of state to serve as a parliamentary draftsman to influence legislation. And then you can then stand in that compliance officer proponent, because it's about holding everybody to what? Compliance. What is the compliance? Insurance and reinsurance. Whatever you're doing has to be insured, and when once it's insured, it has to be reinsured. That's the rule. So your entire algorithm is designed to put you right back where you started, which is insurance. And that insurance can only be authenticated through accounting. So the private and public sectors and specters, if you will, are all operating in tandem together simultaneously through credits and debits, the private versus the public, or the public versus the private, working in tandem. All these things are all verified through accounting. And this system just helps you keep track of all that activity. Your ability to create wealth, pass along wealth, let's be clear. If you have a certain amount of gold and silver tethered to melanin, whatever you attach to that platform is bankable and marketable tomorrow. As long as the value can be made liquid 18 months from today, you get to use that value tomorrow. You get to put it on your books and use it in two different places at the same time. Eris helps you as a compliance officer perfect that proponent. In other words, I gave you also this document inside of your Bitrix earlier over the weekend. You guys are looking at my Bitrix screen. So we're going to go back to something I posted that said it should be the fundamental for notaries. The civil law notary principles. I gave you the supreme mathematics. And the reason why I gave the supreme mathematics is if one stands for unity, commencement, importance, and emphatic. Two deals with differences, the sense of opposition or division. Three deals with completion and resurrection. Four deals with comparative works. 3 + 1 = 4. And always in reference to material creation. These are references. This is how you're able to create perpetuity by converting the words to math. For example, UCC 1-308. There's a 1, there's a 3, there's a 0, and an 8. If you sum that up, what is the numbers that you will have?
3. 3.
Okay. Now, you could explain this to someone in the aspect that UCC 1-308 represents the completion of an accounting cycle and the resurrection of an estate as a result. You could actually use the 1, the 3, which is 4, and the 8 as 12. And as long as you're reserving all your rights, you're showing true governmental perfection. Do you guys get where I'm going with this?
Gratitude.
So it's not about what they say, it's about what you know. Because everyone that's out there rattling off this, that, and the third, until they define the words, civil law notaries have the ability to provide principles. So it doesn't matter what they put on a piece of paper. When you apply the math, is it saying the same thing left to right, right to left, or is it saying something different? Because it could be connotated. This is where the syntaxing comes in. So these should serve as pillars. Utilize this intel in such a way where you understand without a shadow of a doubt the origin, and then you're able to develop fundamentals from it. In their world of form, they have already been told by some type of algorithm what to do. So you're just going to simply pick up the playbook, pull the rules together that preserve the integrity of your estate, and enforce them and make them applicable and hold everyone around you accountable through accounting. Any other questions? Any other questions? All right. I'm assuming I don't have any more questions.
May I?
Say that again.
Yes.
Okay.
Quickly, with the gold that you have in your possession, and you said you can just write, M3 assets, because in 18 months the gold is still going to be the value of the gold. Do you have to do a UCC1 to give that value of your asset, your M3 asset, or?
Think about the UCC as what's capturing the value and providing it for both commercial use and public inspection. So I would say it depends upon what you're doing. I mean, there are UCCs that are considered non-UCC filings. Like a lot of the notaries do UCCs among each other. So when you do UCCs, I want you to understand the I'll show it to you. Give me a minute. Give me a second. Let me see if I can find one. Let me see if I can find the UCC, because if I say it to you, it's going to kind of go over your head. Let me show it to you. All right, let's see. I'm just going to find a UCC, a random UCC that I got. Let's see. Let's find a UCC that was used for something of value. Let's see. Give me a minute, because I'm going to pull a UCC and I want to show you something. All right. And everybody's territory and state, they have their own variation of the UCCs. So I'll show you this one. All right, let's open it up with this one here. All right. Now, all right. Okay, here we go. So let's share the page now. Typically, most UCCs are going to look something like this. Can you see my screen?
Yes.
Okay. Now, typically, in different territories, different states, most of the UCCs that are in circulation are going to look like this, right? Now, bear with me. I want to show this to you in real time. I'm going to stop the share for a minute. I'm going to do some Googling. Okay. And let's come back, share my screen. All right. You're now looking at my screen, so I'm going to oscillate between two images. First image, you see this banner that's on the UCC? See this right here?
Yeah, the black banner. Mm-hmm.
Right. Now watch this. You see this banner also?
Yes.
Yes.
Okay. Little do most individuals know that the counties already have set up this system because let's use his story, their story. You know, only people on the planet that when they got in a fight, they lost, but they get to tell who won. So we're gonna deal with it as is. In their story, their documents of conveyance had to acknowledge the treaties. And this Jawanta two-road treaty is a commercial treaty. In plain English, it means you go your way, I'll go mine, and as long as I do what I'm here to do under natural law and you're there to do what's being done, there's plenty of room and plenty of earth for all of us. They have to attach the treaty to their documents, the flags, to be able to record intrinsic value, enterprise value. So you should be looking at this document exactly what it is and not what it's been fabricated to be used for. Because when you start digging into this and start understanding, well, it's the same flag, what did you notice about looking at the flag in its different images? What's the first thought that comes to your mind?
The fringes.
Like
The stripes is sort of a part of the American front flag, has that in there as well. Mm-hmm.
Remember, they deduced everything to form so it's black and white. So when you standing in your proper appellation, you should what? Choose a color, choose a brand. See, there's certain things you can do where you ain't gotta say nothing. Hint, hint, wink, wink. We're just having a conversation. Maybe your UCCs might be recorded a little bit differently now that you've seen this, because you can't unsee it.
Yep.
Okay. You picking up what I'm putting down, right?
Yep.
Yes.
Okay. Beautiful. Beautiful. Love it. Any other questions?
I never heard this stuff ever.
How does that translate over to the indemnity bond? Do we have to do the indemnity bond, and should we have the indemnity bond on file before we start?
Here's what I've learned. If you expect grace, you have to exhibit grace. Once you learn how to forgive, you should be able to demonstrate forgiveness in order to expect forgiveness. So, in my opinion, it would be to your advantage to demonstrate that you're out doing your part to make all parties whole. And just an act of good faith, if I am in commerce under these pretenses and something happens, good, bad, or indifferent, you can enjoy the same right of indemnification. So thus the indemnity bond can be placed into a form of a surety, this, that, and so forth, and placed properly in line with all the other securities that are being traded around the planet. Matter of fact, the two-road Jawanta merits it.
Well, where would you place it? I'm still not clear. Where would you place it? You said in line with all the rest of them. Is that placed just on a UCC or?
Let me show you another form. Bear with me. It might come up. They might not let you see it, but we're going to try. We're going to see. They may. Let's just see. I know once upon a time, they used to let you see it. Let's see if the AI has caught on. D. Yes, they have. So I can't do that. Let's just say for laughs and giggles, when we do PNs, what we call private COVID insurance, PCI insurance, a lot of times, a lot of our participants are going to need some tests and various different things done by practitioners, and they want to utilize their private insurance to do so. So that institution is going to hand them certain medical forms that are going to have intake parameters. And the intake parameters also has this same flag. Matter of fact, anything of commerce is going to have a flag that they'll call a banner. And there's a reason. Like the Admiralty claims that the AI is using, they too have a flag. This is why I read off in the most arbitrating proceedings the affidavit of commerce. That constitutes the rules and legal maxims that are governed under that flag. This is why no one is supposed to be making unbonded statements. So yours technically, since you brought it up, are supposed to have private indemnities already. I'm just going to assume you got them. You just haven't declared them on the record.
Correct. I do. I just haven't declared.
Right. And so the record is a matter of for what purpose? Because anything that's private, if you take it public, is no longer private. See, there's a way to mention on the UCC that it exists without making it public.
Through the flag, through the banner.
Right. There's a lot of ways of doing it. And that's where the research comes in. Again, a lot of Moenas who are preserving the integrity of the estate, if she's bringing harmony back to her house, she has to set the house back on even keel. She's just not doing everything from one mother's perspective. She's trying to reconcile both sides of the house, the mother's side of the house and the father's side of the house. Remember, women and children were always spoils of war. So now that you're competent and conscious, you have a great work. So you have to be able to take all of those wrongs commercially and make them right, and all those rights to make them even better so others can benefit. Then it's a matter of just bringing balance. Guys, don't get offended on what I'm finna say. You know, I heard a long time ago, raised by a lot of matriarchs in my family, that a lot of the men would say, well, I run my house. And then the women will shrug their shoulders and say, yeah, honey, he runs the house. But truth be told, the women run the house. They just make you think you're running it, Same thing here. Once you gain this information, you're learning how to operate on all sides to give everybody the change they want to see. And the elite have been charged with this information. Do they pervert it? Do they take advantage of it? Of course they do. But the information isn't bad or good. It just is. So now that because as a notary, you are a gatekeeper. You have access to these records. You can't unsee this stuff. I'm just giving you what was already in front of you. When you step on the other side, you're going to really be like, whoa, okay. There's no difference between a UCC and a medical form. There's no difference between a UCC and an insurance claim form. Wait a minute, it's the same form. Right, it's form over substance. Wait a minute. All these companies just creating their own version of the form. Right. Ain't that what we supposed to be doing? Maybe. The rules are there if that's what you choose to do. I can tell you that. There are treaties. There are policies, provisions. There are interests that if you decide to go that route, there's an incentive there. Any other questions?
One last question. It's almost there. It's almost clicking, but okay, one last question. Mm-hmm. So, I know it's beneficial for us to have these items in our ledger because the elites are pushing for everything to go digital, but for us, it's in our best interest to have everything documented. Can you elaborate on that?
Right. To elaborate, it's great that everything's going digital because as long as you know to still create print, you will never run out of a business. You'll always have work to do, and you will always be the smartest person in the room because digital is going to create a higher value for what's in print. So everything that you make digital to bring balance, you're also going to convert it back to what? Print. Only the author of a book can testify to the authenticity and validity of the contents within. If you do a case in arbitration and then you take that case, dress it up into a binder. I'm using these connotative words now. You bind the document. That constitutes a book, and only the author of that book can testify to the authenticity of the validity of it. So if you want a case to stand on its head and have merits, bind it and authenticate it, and then it can be used to save others.
Gratitude.
Beautiful. All right. Look, I am loving the questions, and this is not the end. This is only the beginning. I just got arbitration cases I need to go ahead and get knocked out because the natives are getting a little restless. So I apologize for not going longer and harder than what I wanted to do, but don't fret. This information is designed to enlighten everyone. Give me about 10, 15 minutes to repetition a couple of things, get this actual class up inside the Victory Space for all to enjoy. Homework. If you have not read the manual that we just talked about, please do so. If you haven't learned how to use moral hazards and adverse selections in your sense of reasoning, please do so. Use the AI because that's what it's there for. We're going to be bringing more exclusive content. I got a lot of stuff in queue, which will be coming down the line shortly in wtdtaradio.caster.fm. And with that,
when will you turn us loose in the ARIS system? When are you thinking? What's that?
Say that again.
When will you turn us loose in the for the ARIS using the ARIS AI?
Pretty much. I'm hoping I can turn you guys loose in the next 5 working days because I got a lot of stuff to do. I hope you're ready.
Okay.
All right. And with that, look, I appreciate the time and energy. Stay engaged. And we'll keep doing what we're doing. As long as you guys are here, we ain't going nowhere. With that, I'm going to say peace and love, family.
Peace and love.
Peace and love.
All right.